Brought to you by Prescient Investment Management. Informed by science, guided by insight. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. We've got a little bit of a different kind of an episode today because we're taking your questions and hopefully we're going to give you some good answers to them. But the questions are getting a little bit more difficult, a little bit more complicated for me. So I decided to bring in the heavyweight backup. And so I'm really thrilled to have Ray Mhere, who's head of retail at Prescient Investment Management, joining me to help me answer your question. So Ray, thanks so much for braving the microphone with me.
Thanks, Warren. Heavyweight, certainly, but not necessarily in terms of knowledge, eh?
We know on Strava now that you're a running machine, so you're less of a heavyweight than you used to be. But Ray, it's been an interesting kind of time, I think, in world markets and global conditions all around are kind of making the need for financial information, financial education, important. I should say it's increasing all the time, the need for that. And so it's great for us to have this kind of a forum where we can provide, I think, sensible answers and education without trying to be biased. And I think that's the whole point of Honest Money.
Yeah, I agree. And I think if you think the last few years, it's been everything you listen to, the media, everyone, every second word is unprecedented. So I'm even struggling to keep up with what's happening in the world. So yeah, I think for the listeners out there, any questions that you have, please do ask. And if we can help, we certainly will.
And maybe just to stay on that, I know we need to get to the question, but the thing about the current dynamics in the world, they're not unprecedented, to be very clear as far as I'm concerned. I think what we had in COVID was certainly a huge event, and that one could easily argue was unprecedented for at least 100 years. But in the current set of circumstances where we've got rising inflation around the world, interest rates rising, global uncertainty, those are, I would argue, are kind of normal conditions. These are, in other words, we've seen rising inflation and rising interest rates many times in the last 100 years, and there's kind of a playbook for this. That we know how this movie kind of goes. Yes, the actors are changed because it's a new generation of actors, but the point is this is a well-known script. If we're staying on the movie theme, and so in this instance, I just want to say to people, don't be too concerned that there is a major risk to the whole world's financial system, or this is not like 2008 when we all had real concerns that the financial system could fall over. What we've got now, there might be some individual companies that will fall over, and a few countries that might get themselves into trouble because they're over indebted. But certainly the whole financial system is not at risk, and investment managers in this environment, certainly from South African point of view, know how to deal with inflation. I think European and US and UK fund managers, especially those under the age of 45, they don't actually know what it means to manage money in rising inflation environments. But for us here in South Africa, this is kind of old hat. We know what to do, and we know how the kind of the story ends. We just don't know exactly when it all happens.
Yeah, spot on. And I suppose that's the point of a podcast such as this, just to cut through the noise.
So without further ado, let's listen to our first question, and let's do our best to give some sensible answers.
Hi, Warren and Ray. Thank you for the awesome show. My question today is about investing in a holding company versus investing in an individual company. What is the difference? How is it set up? And what are the pros and cons of both? Should I rather invest in holding companies, or should I rather invest in individual companies? Thanks.
Holding companies versus individual companies. So a bit of jargon there that we need to just explain. But Ray, I'll give you first crack and then I'll have a go.
Thanks, Warren. That's a good question. I think that the definition of a holding company is a company that's structured in a way that it can invest in, it can own other companies within it. In most cases, I think in almost all cases, that holding company doesn't provide a service or sell products itself. It exists. Its main purpose in existing is to buy other companies within it. And in the investment holding company kind of space, where you can buy companies such as Remgro and PSG that own other companies within them, they tend to buy other listed companies that you can find on the stock market, or in some cases they actually buy companies that are unlisted and you can't find them on the stock market because they are venture capitalist kind of companies that, they spend a bit of money building up. They find smaller businesses that are interesting, give them a bit of capital and watch them grow. And hopefully one of these businesses will get listed on the stock market. So that's what a holding company is. And then obviously versus, I think the question was a holding company versus owning an individual share or a stock. I suppose if the shares or the company that is owned by the holding company is a listed company, you could also access that same company yourself by buying the share on the stock market directly. The ones that you can't access are the unlisted companies, unless you can't access the unlisted companies as easily because they're not on the stock market.
Yeah, I mean, I think that's a good point. So to me, it's interesting to watch investment fashions come and go, because a few decades ago, for example, it was the flavor of the month to actually start investment holding companies, and the logic was that, me as a private investor, I'm not going to have the time or the expertise to go and become an expert on mining houses, banks, insurance companies, etc. But what I will do is I'll allocate my money to a holding company management team that have the time, the resources, the expertise to go and become experts on a range of things. And so that was the original logic. The problem is that as information about investments and about individual shares becomes more and more available, and the access to research becomes democratized, so the need for those kind of specialist holding companies becomes less and less and less. And so what we've seen is that you find a holding company that pays management teams a fortune of money in terms of big salaries, and then the cost of being listed is rather expensive on its own, and so all of a sudden buying those 10 individual companies, to use your example, becomes actually a more effective way than buying the holding company, because you're just actually paying away fees without potentially, I mean, let's just say, for argument's sake, not as much benefit as you got in the past. However, now, to go full circle, the fact that more and more bigger businesses are not listing means that there might be the need for holding companies again one day, if not today, maybe one day, because they can access those unlisted businesses, which is very hard for you and I to do as private investors. We don't sit on the tens of millions or of dollars that we can just buy unlisted companies. So I think that's the one comment, and then I think the other comment, and it's really my own, is it's actually much easier, for example, if you don't want to do the research on individual companies, and you don't necessarily want to sacrifice that big discount of holding companies. It's actually much easier and simpler to just buy the blooming unit trust that actually buys those underlying companies, but at a much reduced cost and in an extremely transparent way. And I think that's the problem is, some of these investment holding companies, you find these management teams getting enormous salaries, plus they're getting these real big, I think, very skewed bonuses for no performance. So one of the very big kind of critiques was around Naspers, because you find this management team getting paid a lot of money, and actually they're benefiting simply because Naspers owned Tencent. And so the argument was, the CEOs sitting in the Netherlands, are they justifying their existence with big salaries actually for no real benefit to shareholders? And that's the criticism around the world for these these kind of blended holding companies. So I mean, my view, if someone says to me, is it an either or, either a holding company or individual companies, I'm not convinced that there is such a pure answer. I think I would find it very hard to tell someone not to buy Berkshire Hathaway, which is Warren Buffett's version of a holding company. I think it's an extremely good business. It's got a very long track record, very low cost to kind of management. If you had to say the running costs of it. own some enormous, unlisted businesses, that are specialists in energy, railway lines, and those kinds of things, which are just impossible to buy any other way. But if someone said to me, I've got expertise in banking, and I know that XYZ Bank is the best bank, in the world or in South Africa, I'm going to buy the bank. Then you should do that, because you've got expertise that's deep. And maybe specialist compared to everyone else, then sure, go and buy the individual company. But if you're looking for kind of just access to the stock market, then and you're not going to do the research yourself, then my answer is going to be buy a unit trust or buy an exchange traded fund, but don't try now and become a share expert on your own if you're not going to put in the time and the effort.
I like that, Warren. I like the way you're thinking about it, because if you are, whether you're buying a holding company or a unit trust or anything that kind of pools your money with other people's money to buy these things, you still have to understand what's going on in there, right? So you got to, as much as you kind of look into a unit trust and you look at costs, you look at what does the manager stand for, do they have a specific expertise, like you mentioned, like all the due diligence you would do on a unit trust fund or an ETF, you should probably do for the holding company as well, because they're essentially doing the same job. Pooling your money and other people's money in there to try and access these companies. What's interesting that you mentioned earlier, I read somewhere in South Africa, they actually, a lot of these holding companies started out because they thought they could do it cheaper than unit trusts. And this was, when unit trusts were perceived as very expensive vehicles for clients to invest in, and before the ETFs kind of boom had come in. And I don't think it's this case now. If you look at what's happening in the unit trust industry in terms of fees, coming down and pressures on fees coming down, and also the kind of emergence of cheaper alternatives to buying into the stock market, such as ETFs. Like you said, I think you have to question how much value the holding company itself adds, given the cost in terms of investing in those underlying shares or companies.
And so maybe to kind of wrap up on this, the honest money view is, exposure to the stock market is a great idea. We think, shares are the engine of growth for most investment portfolios, from people that are saving, 300 Rand to people that are saving 300 million. Shares are your major engine of growth. The things to understand are, you need to be very clear in terms of what you're buying. You need to be very clear in terms of the costs of what's going to happen when you go in, what happens when you go out, and what happens on an ongoing basis around the fee. So it's, do your homework around that, and then be very clear on what you're actually going to own when you make that investment. And then, are we discouraging you from buying individual shares? By no means. I think, people that do the homework and are willing to take the risks of being in individual shares, I think it is a good idea. It certainly will focus your mind on being in the stock market. But if you're not going to do that, then my view, the honest money view, would be look at the unit trust market, look at the exchange traded fund market. There's some really good ways to access the stock market that way, in a potentially much more diversified way. And I think that's the key in this. You can't buy one share and bet your whole financial future on one company, even if it's Berkshire Hathaway. And Warren Ingram says he likes Warren Buffett. There's no way that you bet the house on that. You can't. It's just not sensible investment strategy. Ray Mhere from Prescient Investment Management, thank you so much for joining us and for being willing to kind of share your knowledge and expertise with us. I think it's valuable to have another voice with a different view than just mine. I'm looking forward to having you on the show to do some more of these again in the future.
Thank you, Warren.
Brought to you by Prescient Investment Management. Informed by science, guided by insight. Prescient Investment Management is an authorized FSP.